Good. All right. So in the morning, we had a nice run up and it was kind of slowed and controlled. It really wasn't until they put in a high, which would be right here, that we started to see in the chaser really big offers. What do I mean by that? Well, let's back it up. Right in here, you started to see this number approach 1,000. That number never got that high anywhere in this rally. Doesn't mean you could have got long and stayed long and it would have been easy. It just kind of gave you indication that not that many sellers were showing up on this run up until in here. And you could actually see, if you look at this number here on the right middle of your screen, you could see it reach 1,000 at some point. And it goes back in here, actually. So what did I say in here? I said at this point, got about 1,000. I said that could be a high, or it could, it's the first time that the chaser looked like this. So the market tried to re-rally using the green as support, then using the red as support, and then it slid through it. And I'm just going to fast forward and say all the way down here, it's easy to say it's bearish. Too late. That's hindsight's 2020. But was there anything in here that could have said, don't get long, even if you're bullish? That's important. Saving money is like making money. So if I bring it back, right here is a moment where we're at a red PWAP, off in a great support area. It had worked as some pretty decent support. The green one did right in here, right? Bottom of the consolidation. But take a look at what the market's telling you. There are more longs than shorts. So you want to jump into that party? There is 1,000 on the sell side for the chaser versus just 255 on the bid. That is the warning sign. Don't get long, don't get long. And the market flies through and would tell you or disqualify any potential bullish execution, which means getting long. Slices through there. At this point, right down in here, you have to say, hey, generally doesn't slice through a level like that. It's bearish. Market breaks a little bit more, comes up first attempt, and now it's going to use the red PWAP as overhead resistance and comes off. It's not a coincidence that it went up almost to the tick to our red dotted line. What that is where the market is short from on average over the last hour. But is there something to qualify that price? There's nothing to disqualify it. You get a big market order on the buy side that gets rejected. You have already a green laser showing you there's a healthy amount of longs that could keep the downside intact. All right. And you start to get the bids to dry up. Right now, it's like 1,000 up, 1,100 by 900 on the chaser, right? And I fast forward it right in here, they start to shave off. Now, that's a few ticks below that red, but if you're expecting the volatility of this downside to continue, you might be able to reach right there. Now, that's kind of a aggressive reach. But remember, you're doing it with already a green laser, which means a nice amount of longs versus shorts right here. And this guy right in here, a buy market order comes in, and the market doesn't even budge to go higher. This is called a rejection. So this blue box comes in, which is a big market order on the buy side, and price never even gets above where that guy came in. That's the metaphor. Punch a guy in the face and he doesn't flinch. Forget about getting knocked back, falling down. He don't even flinch. I don't know about you, but I'm running the other way. Price is you in this metaphor. It's the guy throwing the punch. And so that could be for those that might be a little bit more aggressive. I don't think it's a very aggressive short by using just that, because you don't just have that rejected buy market order. You also have a healthy amount of longs in the market that are stuck all the way down. You have a pretty bearish move slicing through the red PWAP moments ago. And so it curls over and falls. There was another moment where it got kind of close to the red PWEP and rejected another big market order, and a bunch of longs came in. Again, qualifying measures to get short and stay short. As we then went sideways a little bit and then smashed through right here. Let's say you're playing a breakout. You see these rotations here. It's the bottom of kind of a consolidation. You want to play a breakout. What could give you a better win moment? Well, right now you got the chaser lined up, 980 versus 363. But when did that go to 900 to 363? Back it up a little bit. All right, stay right here. So if I play it, it's balanced, slightly more buyers than sellers, 2-to-1 buyers, sellers, and then boom, a flip. Now it's back to balance. Okay, balance, and then boom, the sellers take over. The longs are already in as a green laser, more longs than shorts. Got it? Then you get that 2-to-1 right here. If you're aggressive and you take a shot at getting short, playing a breakout, you want to see the chaser stay in balance, which means more sellers, not shorts, sellers than buyers. You really get the nice ratio in here. Should be able to see some volatility to the downside. When I say volatility, it should start really, coming off. You got a nice little ledge here. They hit that, they could go. All those things, as you've got a little advantage because you got a little head start, you're able to watch these things a little bit more objectively, because the definition of a good short is the price starts going down sooner rather than later. And you could see it skip like that because of what the chaser is saying it should do. The difference between what it should do and what it does do. Now you got two big sell market orders, but price does go lower. Different than rejection, right? This is reading order flow, whether it's market orders that come to the market, and now your job is to read whether or not price is doing what it should do. And then where future buyers and sellers are saying, I want to sell it, I want to buy it. And how many are future buyers and sellers? Put the word future in front of buyers and sellers when you're reading order flow, because that's what you're predicting. You're not predicting the buyers and sellers right now. There's nothing to predict. You could see the buyers and sellers right now. They're shaking hands, going back and forth. If you're trying to trade, it means you're trying to predict the future location of price. Therefore, you're trying to predict future buyers and sellers. Everybody could see existing buyers and sellers, meaning people who are actually getting filled by buying and selling. It's future buyers and sellers that are going to give you insight as to what's next. Take a look at down here. You've seen these two market orders right here on the sell side, push price lower. Watch these two down in here. Look at the damn difference. Look at the difference between those two and these two. All right. Those two got price to go lower, below where they came in. And then watch these two. All right. Good. You got one, you got two. Boom. It's right back into it and then gets above it almost within seconds. That's reading order flow. You're seeing how price reacts to a big market order. So when you do care about real-time buyers and sellers, it's in this context only. How the F does price react to this new information of a big sell order that came in aggressively? You've seen how it reacted this way, which would be a little bearish, right underneath it, and this way, when it got above it, to be a little bullish. So the market was going to do this, which means just drag up a little bit. And now it doesn't seem like a good guess when the market drags up a little bit. Oh, by the way, the shorts come in. It's going to flip this laser from green to red. That's also bullish. Goes red, goes up. These are tools that are giving us insight into what's going to happen in the future. And as traders and investors, that's our job. You're not trying to predict the past, are you? So stop being too focused on the present. Other than big market orders and how price reacts to them. And then what is the present positions of the market? Because the present positions of the market is giving us insight into the future buyers and sellers. Put the word future in front of buyers and sellers. You'll start reading order flow much better.